All right, can you hear me now? Hello. All right, can you hear me now? Hello. All right. Just waiting for a few more people to join, and then we'll get started. Let's back up to the top. Just a couple people on so far. I'm one of the watchers, so that cuts us down to 3. Come on, guys. A couple more, and we'll get going. All right, let's get kicking, and folks, please feel free to throw me a 1.5 times speed, get caught up to where we are at. All right, welcome to week 5 of the Rational Investor School for Trader Development. This week we are talking about, we're doing a very surface overview of technical analysis. We're going to go a lot more in depth, both into technical analysis and the individual indicators and settings that we use. But this week we just wanted to give you, like I said, a high-level overview of how TRI approaches technical analysis. So we're going to cover technical analysis defined, 3 different types of technical analysis, in particular price analysis, indicator analysis, and intermarket analysis. And we're going to talk a little bit about your technical analysis or TA toolkit. All right, so technical analysis ultimately is a study of price action. Brian gives an illustration of a fundamentalist and a technician in a shopping mall. I think that's pretty good part of the video there. It's a good description of that. And he talks a bit about how the market ultimately is the final arbiter, right? We may have a very good reason for a trade and a very good setup that's been vetted quite frequently, but it is never 100%, and the market very well may do, as Brian says, any damn thing it wants to do, right? It can move against us, and so this is part of the reason that we control our risk. Is we can predict with a certain degree of accuracy, but definitely not 100% future price action in the market, and so that's an important thing to know. Just because you had all the right signals, if the market moved against you, that doesn't necessarily mean you executed it incorrectly. You may very well have done a good job executing it. It just may be one of the times that the market did a bit of a head fake on us. And technical analysis works best in absence of new fundamental drivers. So one of the things that can really mess with us, to use a highly technical term, is when we have a technical setup and then something fundamentally happens. There was a few weeks ago, there was a bot that showed up on a bullish bot that showed up on Tesla, right? And then Elon Musk did his now infamous going private tweet, big fundamental event, just destroyed that bot, right? So the best time to do technical analysis on an asset really is when the fundamentals for that asset are relatively quiet. There are three base schools of technical analysis. One is price analysis, direct price analysis. The second one is indicator analysis. These are derived from price, but typically are a measure of momentum. And last but not least, intermarket analysis. And that's where we are looking at relationships between different markets and perhaps using a particular asset as a proxy for the overall market that it operates in. By the way, I had to use a different mic today, so hopefully this headset mic's working okay for you guys. Let me know if it's too quiet or anything. All right, and then something we very much like is to confirm what we're looking for with a higher time frame. We really don't like, as he says in here, swimming against the tide. We also refer to that as catching knives. We don't want to look to put in the tops or bottoms, right? Or catch the very tops or bottoms of moves. What we want is for the big fish to have put in those tops and bottoms, and for us to follow along in their wake, if you will, right? We want to go with the tide that they generate. Awesome. Thanks, Philippe. Okay, so price analysis. We will refer to this very often as price structure. And what we're talking about here is patterns in price that indicate a reversal in market state. Now, that may be from trending to ranging. That may be from one trend to another trend. That still looks like ranging until it breaks out, right? So really we're looking at trending versus ranging markets ultimately. Now, when we're talking about a trending market, right, we're talking about lower highs and lower lows. Okay. When we talk about a ranging market, we're talking about action that is within kind of a set of highs and lows. Let me move this down just a little bit. And really, this range is probably more like here and here. We will occasionally see dips in and out of it, but that would be a range that this is operating in. This would be a trend that led into it. Okay. So that's what we're talking about, is defining or predicting really when we're about to see a shift between trending and ranging markets. The key part to remember is when you're trying to determine whether you're in a trending or a ranging market, you want to see overall, preferably on a larger time scale first, right? Most of us will look at a weekly scale first to get an idea of trend, and then we'll drill into a daily or 4-hour or shorter time frame to look for a setup that corresponds with the trend that we're in, or if it's a ranging setup, we'll look for a setup that works with that range. Okay. The most common reversal indicating price patterns that we see, there's basically 7 of them, right? There are double tops and double bottoms, or M's and W's, right? When we talk about a double top, we're talking about an M. When we talk about a double bottom, we're talking about a W. We see triangles, right? Those can be a symmetrical triangle, an ascending triangle, which has a flat top but a bottom that is moving up, a descending triangle, which has a flat bottom but a top that's moving down. Then we also see head and shoulders or inverted head and shoulders, which look like this, where you have a shoulder that comes up, then it comes down, so the price will come back down. then it'll come up, make a higher peak, so that's typically the head, right? You can see how this is more of a W here, and then it will form an M afterward, where the right shoulder is that right shoulder of that M, right? And that is all confirmed when the two low points are at the same, what we call a neckline, right? And this is one of those things that we have some predictive power in here. When we see a head and shoulders or an inverted head and shoulders, if you measure the distance that it moved from the head to the neck, typically we will move that distance again past it, right? So so you see here the double bottom and the double top, right? Ideally, we want to see on a double bottom, we want to see the right hand bottom a little bit higher than the left hand bottom. Even is fine, but we like to see it if it's a little bit higher, right? When we talk about whether a W or an M is confirmed, what we mean is that price has closed, not just moved, but closed above this level. Okay, that becomes more apparent when you're looking at candles. So we're saying when the candle body finishes on that candle above this level. But the key part is we may see price move up into and out of here throughout a day, and we don't want to call this confirmed until whatever time frame we're on, that we have a point finished above this level. Okay. Similarly with an M, we're looking for a price close below the neck, right? So these are the primary, when we say there's 7 market structure patterns, this is what we're talking about. The 3 triangles, head and shoulders, inverted head and shoulders, and double bottom and double top, or W and M. Okay. We look for confirmation of these with volume. So we can come back to here. Okay, this is the S&P, right? When we see a W come in, like what we see here, okay, we see it go down, up, down, but not as far, and then up. When we see this confirmation here, what we really want to see is just above and hold on just a second. Feel free to throw it on arrow. When we see a W come in like this, the other thing we look for is volume to confirm it. So what we're looking for specifically is something we call volume impetus. We'll get into that in more detail later, but what we want to see is 3 higher. Let me see if I can. 3 higher bullish bars for a W. Okay, we have these 3 higher bullish points here, here, and here. Okay, that gives us some confirmation that this W is valid, and sure enough, price moved on up. Okay, if we see an M come in like we do here last few days, and yes, I know this is the S&P 500 and this came in the last few days, that's a little scary, but when just on the basis of price action and volume, we have successively higher 1, 2, 3 bearish bars. Okay, so that's our confirmation of that structure. Now, obviously, that's one reason, right? We need at least 3 reasons to get into a trade. We'll talk about that in future classes as well. And it doesn't have to just be 3 reasons, it can be more. But typically, what we're looking for in reasons, right? Most often, this isn't exclusive, but most setups look for location, which we will talk about when we talk about harmonics. We look for momentum, and that's where we'll get into more detail as we talk about MACD and Willie and OBV. And then we want some kind of price structure, right? So that's very often what we're looking for, those three categories of reasons. Okay. Now you may have fundamental reasons as well. You may have it may fit with your fundamental screener, or you may be looking for a fundamental action to be a trigger of an event, right? Those are perfectly fine as other reasons as well. The key part is you want to have them defined in your setup so that you are always operating off of your setup, off of a pre-set plan. Okay. All right, let's get back to this. So, volume to confirm market structure that we see. All right, so 3 schools of analysis here, technical analysis. We talked about price structure. Now we're going to talk about indicator analysis. All right, so indicators are things like this. There's one that Alex put together last quarter. That one was pretty awesome. There we go. All right, so like we have MACD, right? There's a question in the Q&A document that said that indicators looked like to them like they were exactly mirroring price action. You can see when you talk about MACD that is certainly not the case, right? It's similar, but there is discrepancy, and it's really the discrepancies that we're looking for, right? We're looking for areas where we see higher highs and higher lows in price, but we see lower lows and lower highs in the MACD, right? Those are what give us that divergence is what gives us a really strong indication of reversal. Oh, 159. What did I do? Oh, I think it. Yeah, I think it turned off the time frame. Sorry about that. I think I posted that when we were 1 minute and 59 seconds in. Okay. So this is what we mean when we say an indicator. This is indicators are typically drawn off of something like a moving average of price. So there is certainly a relationship between the two, but what we will often see is future divergence, future changes in price are often telegraphed within these indicators ahead of time. Not always, but what we do is we look for those, and those often describe the setups that we are using to get in on a trade, right? Bear in mind, we're not going to capture every move. There's that. There it is. We're not going to capture every move, nor do we want to. We want to capture the high probability moves, right? So the indicator is any class of metrics whose value is derived from general price activity within a stock or asset, right? One of the chief complaints about indicators that you will see out on the internet is that they are backwards looking, that they are based on delayed data. And that's true. But by analyzing these indicators in how they relate to price, we can, when we look for divergence and convergence, we can get a strong future forecast from those, even though these are based on historical data, right? When we see current price moving at odds with the historical momentum, that can show that the price is getting out of whack, right? And it will have to come down. So that can give us a good, strong future indication, but we do need to use it in conjunction with both our other parts of the chart, location and price action, and we need to use it in conjunction with higher time frame trends or ranges. Okay. Indicators. There's several indicators that we commonly see used. We see RSI quite a bit, both in the site and externally. I know a number of people that use MFI, Money Flow Index. I don't know many TRI folks that are using MFI, but I'm sure there are a few. Stochastic and MACD are very commonly used as well, and we will teach you about how we use MACD specifically. And so when we look at oscillation, which a lot of these are oscillating, not all of them, but a lot of these are oscillating indicators. There's only so much of anything that can be traded at any given point in time, so we have kind of this rubber band effect. It gets bought, and it has to come down. It gets oversold, it's got to come back up, right? And then we talk about momentum a bit, right? So momentum absolutely applies to even these non-tangibles like price and market action, okay? When price is in motion, it gets more quickly in motion. Now, a lot of this has to do with the fact that the market is an emotional machine, but it's still very predictable. A body at rest stays at rest. A body in motion stays in motion. Similarly, a market at rest tends to stay at rest, barring fundamental drivers, and a body in a trend tends to stay in a trend until it either hits an area where it has bought all that can be bought or sold all that can be sold, or there are fundamental drivers that change it. And convergence and divergence, and this is what I was just talking about. What we look for in TRI is for price to be moving in one direction, but the indicator to be moving in the other direction. And what we're really looking for on the indicator is M's and W's, right? Maybe a head and shoulders, right? All those market reversal patterns. We look for those in the indicator in the opposite direction that we're seeing them in the price. And when we see that, we can predict with a fairly high amount of certainty, 60-70% of the time, we are going to see price reverse to come into accordance with what's in the momentum. Okay. All right. So that's indicators, and we're going to talk a lot about a number of indicators over the next few weeks. Then we have intermarket analysis, right? Various assets will correlate with each other. Here's the blown up view of that first picture on there. We see the Dow Industrials versus the bonds here on this particular index. This is industrials versus government bonds. Are they correlating? Are they at odds with each other, right? We see the inflation protected versus non-protected U.S. bonds, right? Tip versus tilt. And really, this is tip minus tilt, more specifically, if you want to recreate it. That is a mathematical operator in there, so you can literally type into your thing, into your ticker, tip minus tilt, and you will get that. Philippe, we're going to get into that a little bit more, but that's something we look for quite a bit. It's something that we're going to talk quite a bit about is divergence. So we're just touching on it briefly this week, but not next week, but the week after, we're going to get into harmonics, and the week after that, we start really digging into divergence. So bear with us. We're going to get into it in quite a bit of detail. All right. So it is important to note, if you want to do some calculation here, you can do mathematical calculations in here. If you want to know what is this asset minus like this index minus this index. Okay, you can't do some of the more advanced stuff. I don't think you can average in here and things like that, but you can do those within a custom indicator, which we can talk a little bit about later if there's interest. All right, so we have these relationships between various assets, and those relationships can matter quite a bit, and they can give us a picture of the market that we're operating in. It is important to know that the ultimate fear proxy is cash, right? And when we talk about cash, we're talking more about like T-bills, something very like short-term when we talk about how when we get into a crashing market, people move into bonds, we're not talking about like 20-year bonds or 10-year bonds. We're talking about like T-bills. We're talking about basically U.S. dollar, right? Um, kind of regardless of country right now, US dollar is kind of king. Everything operates on the US dollars, whether it's proper US dollars here or whether it's what's called euro dollars, which are US dollars that are held abroad. But that is the currency in which pretty much everything is transacted ultimately. Um, Local markets are going to be different. You know, if you're in Turkey and you're operating within businesses in Turkey, you're going to trade the lira, right? But if you are trading between a company in Turkey and a company in Austria, um, you're probably going to use the euro. If you're trading outside of the euro into the Asia market, you're probably going to trade US dollar. Okay, so ultimately, that US dollar becomes the most versatile instrument to use. And so as people get into a fear scenario, markets are crashing or whatever, um, they're going to move their money into the US dollar. If there is fear about the US dollar, then they'll look to hard assets like oil or gold. But the first and ultimate fear proxy really is the US dollar. Okay, so um, correlation. Now, something we look at is not just if things are correlated, but if they are poorly correlated, if they are inversely correlated in particular, we really want to see that. When we look at the gold, I don't know if that's on here. If we look at the US dollar versus gold, that can give us a very good picture of um, of of those two assets. Like if we're hunting for a gold setup, something we may look at first is to see the dollar declining if we want gold to be long. And then, yeah, cash means the US dollar in this case, GC. Um, the If we're looking for a long gold setup, we may look to see the dollar go down first, and directly after that, or very close to that, we will often see the price of gold go up. And so when we look at inversely correlated assets, that can be very useful as well. So there are some historical relationships that the market, frankly, looks to quite a bit. Stocks versus bonds, right? Equities versus commodities. That's where we're talking about the fear Dow Gold uh, index comparison. That's Dow theory, right? When we look at yield curve analysis, we often look at yield curve analysis as a predictor of oncoming recession, and market breadth, right? These are all things that we use as forms of intermarket analysis. In other words, it's a combination or comparison of different markets with each other. So how I often use this within my plan, for instance, is on a very high level, like a macro level, and people talk about macro analysis. This is usually what they're talking about. I look at these large scale intermarket analysis relationships. I look at Dow theory to see where are we at in the fear greed cycle. I look at yield curve analysis to see where are we at in terms of strength of bonds and equities, right? And I will look at those things first, and I will drill in then to a more specific analysis of the markets that I'm looking at, right? So I start with big and move into small, so it's a top-down analysis essentially. Other people may go the other direction, but that's how I do it. Just so you know, neither one is necessarily right. That's just how I think. And last but not least, your TA tool belt. Okay, which indicators you use, how you chart your events. You'll hear in the daily brief, Thomas does his price charting using candle bodies and not tails and wicks. Other people, myself included, will use tails and wicks, right? It's a matter of personal fit. it's not that one is more correct than the other. It is about which one makes more sense to you. Which one do you understand better? Which one works better with your plan? Because ultimately, you might have this awesome, ridiculously good indicator, but you don't feel comfortable using it. You're not going to make good trades on it, right? You have to feel comfortable with it. So that's one of the biggest points, right? Ultimately, what you use in your toolkit is going to be what you're comfortable with. The second thing is layering your analysis, right? And this is the biggest thing that I don't see in the broader market very frequently, okay? I see a lot of people talk about the efficacy or effectiveness of indicators or lack thereof, and almost all of their analysis, almost all of their back testing uses indicators in a non-correlated fashion. It's like, well, we tested this one indicator and it's not very effective. Okay, the thing is, no one indicator is going to be effective enough of the time that you can rely on it. What we want to rely on is when indicators agree. When our indicators work in correlation with our fundamental screener and in correlation with our location studies, which we're going to get into in a little bit, and in correlation with our price structure. Okay? When we have all of those things together, we've got kind of the highest probability of success. Okay? That's really critical. Going off of one indicator is almost everybody I know that's blown up their account. That's where it's come down to. They have made a decision based on just location, or they made a decision based on just RSI, or they've made a decision just on market structure. That's where people get into trouble, okay? We really want to see you layering your analysis and only taking action when your, again, predefined setups are hit. And if they don't get hit, you don't take it. Very often, you'll probably see this come up where Brian sees something and says, oh yeah, so if you have a setup for this, this would work. And you'll see me or Thomas or somebody say, I don't have a setup for that. That's what we're talking about. We have predefined what our setups are within our plan. And if those conditions aren't met, even if we can understand why it'd be a good setup otherwise, we won't take it, not in real money. What I'll often do is I'll paper trade it anyway, just to see, hey, maybe that's a new setup that I want to develop, right? So I'll paper trade it and see how it came out. But I certainly am not going to risk money on a setup that I haven't already defined. First of all, it's risky because you don't know the effectiveness of it. Second of all, it's hard to track whether you executed it correctly if you don't have a plan ahead of time, right? And so for those, along with several other reasons, it's a bad idea. You want to define in what conditions am I going to risk my hard-earned money, right? And you need very specific reasons. What are my minimum of 3 reasons that are going to get me into the trade? What do they look like? So that you can determine, did that match that setup, right? Because one of the things you need to measure when you look back at your log and when you look back at your trading plan is, did I execute correctly? Did I had a plan? Did I planned my move? Did I move according to my plan? Okay. And so layering your analysis is critical for all of this. We really want to have a location reason. We really want to have a momentum reason, and we want to have some kind of price reason, right? That's how most of our setups are built. We do have a few where you might substitute one of these for a highly correlated fundamental screener. In other words, my fundamental screeners are like I end up with a number, right? And so if I have like a 3, that's sufficient for me to get into a trade. But maybe like I have a setup where I need at least a 4 to get into it, but that's also one of my reasons, right? But typically what we see with setups is we see a location, momentum, and a price structure reason. All right, and then as you go through, something to keep in mind, keep in your journal and kind of look for it is, can you see any of the market and transition price patterns on any particular asset? See if you can note them, right? Feel free to post them to the group channel and say, hey, I think this is what I'm seeing. Is this right? Honestly, it's huge. That's how we all learn, because you might understand it intellectually, but actually doing it and finding W's and M's and triangles and heads and shoulders, right? And very often you'll think you found them, but you may not really understand some of the nuances of it. So please post out your charts to the group, and we'll take a look and give you some feedback. Okay. Similarly, can you find examples of convergence and divergence? So let's talk a little bit about that, because I know that was a question. All right. So let's look here. So in convergence and divergence, S&P. Okay, we talked about how we saw this W come in here, but something we didn't talk about is this W that came in here before that. Okay, come here. There you go. We had this W come in here before that. Now you'll notice this W confirmed here, price action confirmed here, right? Now we saw this W, but then we saw it come down before it ever went up again, right? So this is one of those areas where we have convergence, right? Convergence means we have a W when price is going up, right? It is less strong when we see convergence than when we see divergence. Let me see if I can find it. I'm not going to find divergence, I don't think, too much here until we get to the end. So we've had this price that was going up and up. We do have an M come in right here. Okay, so this is the fourth. We finally got printed an M here, but it comes down below the zero line. This is the zero line here, right? This M is scary, right? Similarly, we had an M here, so this is our second M. One, well, third really. Two, higher, lower, higher, lower. Three, higher, lower, higher, lower. So we now have three M's on the table in a market that otherwise is going up. Just on those two bases of that divergence, right, and the market structure we have here, this looks like we may be headed towards a down move. Now, there are some competing ideas about this, right, within our own study. Look at the larger time frame, right? If we dropped out to a weekly, where are we at? There we go. On a weekly, we've got just a bullish trend, right? This, we said earlier, we like to not knife catch. We don't want to move against this trend. So it would probably be premature to get into like a short here, right? Because the overall trend is still up. So this might be kind of like this guy here, where we just come back and then come up. You could make some money on that short-term move. I think there's certainly a predicted short-term move on the daily, but like if you look at the weekly here, this is not an M. That right side is higher than that left. So this is not an M. This is the W right here, and it hasn't M'd out on a weekly, right? So we really want to see that change. Let's look at another asset. Divergence. Let me see if I can find a divergence here. Okay, so here, this is not a bad example of this. This is Stratasys, right? So we've got this movement down, right? Even in consolidation. So we had this long trending move down, and then we've been in consolidation here for a couple of years. But while we've been in consolidation for this couple of years, we are also coming close to printing a good W, right? Technically, you could say you printed a W here, right? What I would like to see, because we started this consolidation here, is I would like to see a break above this level, right? Because we're up to here, and then we came down to here, up to here. That's a lower low, so I don't really want to count that. So really, it's this high down to this low, right? Then this high, this low. So what I'd like to see is a reversal before it gets below here, and then come up above here to give us a well, really, it gets above this level to give us an overall W. Now, if that came in while this is still sideways, or preferably down, that would be a divergence, and that would give us a good signal to move on. Okay, let's see if we can find another one. Let's not do BTC, that's a little hot right now. Let me see if I can find you one. Some recyclables. Might want to put this off to the class where we're actually talking about the indicators, but let's see if I can't find you something. That's W. Nope. Here we go. All right, so let me move this. I'm going to replay this back to the level where we had it. Okay. All right, so point in time. What we're seeing here, this is VF Corporation. Okay. We were seeing price making lower lows, right? Sorry, lower highs and lower lows. You can already see this is starting to kind of triangle down to a descending wedge. But so we've got this happening. At the same time we have that happening, we have right here a rather beautiful W. Okay, so here we've got higher lows, right? And at the point that it breaks this, we're printing higher highs as well. Okay, that's why we look for that break there, because that's when we get higher highs with our higher lows. So we've got this W that comes in right here. Okay, and that's in strong divergence to this price. I'm not 100% sure about location on this, but let's go with it for the moment. So let's pretend like we had a good location indicator. You guys will learn what that looks like later on. But then we've got our indicator gives us a W, right? And so let's go a little slow. Let me speed it up a little bit. Then price prints a little W here. Wouldn't be a bad spot to get in right when that confirmed, right? And we're seeing price just start moving up at that point, right? This is what we're talking about. This move, this reversal in momentum, predated the reversal in price, right? And we will often see this. This is a pretty strong signal when we get that divergence. Now we've got a larger W that's printed here. This one's the pretty W that I would really go off of, right? This is on weekly also, by the way, guys. So several weeks occurred between these two, right? And then we see the price move up, right? That's what we're talking about with divergence. This higher highs here, higher lows here, while we're making lower highs and lower lows here. All right. And sure enough, if you'd gotten in there, quite a bit of profits. All right. Hopefully that makes sense. Philippe, that's what we're going to be looking for. Anybody else who wondered about that? Because I know that this is a major consideration, all right? Something really significant. We're going to look for divergence in all of our indicators. When you learn about MACD, you're going to look for divergences in MACD. When you learn about the Willy, we're going to look for divergences in the Willy. When you learn about OBV, we're going to look for divergences in OBV. Very, very strong indicators. Okay, very, very strong signals. Again, we don't take any one signal. We need at least three, but very strong. All right. What else we got? I think that was the end of the deck. All right, so let's do the quiz. All right. There are how many primary schools of technical analysis. Oh, hey, Philippe, I'm glad that that helped. We'll go into it a lot more too. So that was just a really quick one-off, but I wanted to give you an idea of where we're headed with that. Okay. So there are 3 primary schools of technical analysis. We just talked about price or market structure. We talked about indicators, and we talked about intermarket analysis. Okay. And the Dow-Gold ratio is an example of which type of technical analysis, right? Well, if you remember from the deck we looked at, that is one of the things we specifically call out in Dow theory for intermarket analysis. And intermarket analysis is anything where we're looking at 2 different markets, the Dow Jones Industrial and the gold market, for instance, and are comparing and contrasting those. And there are 2 primary market states, and those are ranging and trending. Now, this is something that's going to come up a bit too. So, ranging and trending, how do I put it? They're very interrelated, okay? Any asset, given enough time, is going to be ranging, right? It's going to go up and it's going to go down. Any asset on a sufficiently short scale is going to be trending because you're only going to catch one part of that move. But it is important to note whether it's trending or ranging for the purpose of the time frame that you're looking to trade in. Okay, so typically I look kind of one time scale up. I often trade on a 4-hour time frame. Since I'm trading on a set of 4-hour candles or 4-hour points, I will often look to the daily and weekly to give me an idea of whether I'm in a trending or a ranging market, and if I am in a trending market, which direction is it headed? If I am in a ranging market, am I nearer the middle or nearer the ends of that range? Okay. Because ultimately what I do is I look at the trend, I look at the range, and that tells me, am I looking for a short setup? Am I looking for a long setup? Right? So ranging and trending, 2 market states. Ranging markets are where you have either higher highs and higher lows or lower highs and lower lows. If you have higher highs but lower lows, you are in a range. It is a widening range. We often call that a megaphone. If you are in a lower highs and higher lows, you are also in a range. You are in a tightening range. That's a triangle, right? And ranging happens pretty frequently. Markets tend to range about 70 to 80% of the time. Okay, trends are usually fairly short-lived. Usually, if you look at the S&P, it's been going on for quite a while. But the thing is, the longer a trend continues, the bigger the move down has to be when it starts consolidating. All right. Term used to describe a change in market state, market from one state to another is called what? That's where we're looking at market structure. Okay, when we talk about market structure, we're talking about looking for a change in state of the market. And then the 3 primary trend change formations taught in this course are what? Now, remember, there are seven scenarios we look for, but those break down into 3 primary change formations, right? Looking for M's and W's, heads and shoulders, and triangles. And then indicators measure which 2 internal technical gauges. Okay, these are indicators. And what they're going to measure is oscillation and momentum. And then an indicator is said to be in what state when it is not making new highs, but the price of the asset is making new highs. All right, that's where we're looking for divergence, right? And that is something we look for very, very commonly. Generally speaking, when we are looking, we have setups are broken into in my plan anyway, are broken out into the 2 market states, trending and ranging. When we are in a ranging state, which is 70-80% of the time, what we want to see is divergence. Because we want to see a reversal from that into a trending state. If we are looking to trade into a trending state, we will look for convergence. right, to indicate that we are not about to reverse back into a ranging state. Technically speaking, two stocks that move very closely together are said to be highly correlated. It's important that you get this term down because you will see it a lot when you're reading on the markets. They'll say something that two things are correlated quite frequently, or inversely correlated if they are the opposite of each other. All right. Stocks and bonds usually move in opposite direction, which means they therefore must be inversely correlated. And then, which of the below is an intermarket analysis relationship? Well, we talked about the dynamic yield curve, which is a relationship between short and long-term bonds, which behave differently from each other. We talked a bit about Dow theory and market breadth. We didn't discuss much about futures term structure, but that is certainly something that factors in, and that's probably where the question. So I had a question in here, and I asked for a video time reference or some context to explain what futures term structure was. We'll talk about that in just a minute here. But the answer is all of the above. These are all intermarket relationships. Okay. Well, in fact, let me pop over and do that as soon as we're done with this quiz. We got 8 more questions. So that'll be the next thing I talk about is future term structure. All right. Technical analysis is a proxy for what? This is important to understand, right? Ultimately, technical analysis is a proxy for supply and demand in the market. And really, price is the ultimate descriptor of supply and demand in the market. It's really important to understand that, because if you understand supply and demand, you're going to understand a lot about how to do analysis in the market. And then technical analysis works best in absence of what? And that is new fundamental drivers. New fundamental drivers can completely invalidate our technical analysis. And then technically speaking, why do markets range 70 to 80% of the time? Another thing that's important to understand, and this has to do with the supply and demand nature of price, right? What we're looking for when we see a range, what the market is looking for, is to find equilibrium in levels of supply and demand that have been, and trying to identify them, okay? And when we see a range, we can establish that we've identified where the equilibrium is, and those will stay until we get a new fundamental driver, which will either drive it up or drive it down. And then what technical indicator do we use to confirm market structure and patterns such as head and shoulders, M's and W's, triangle patterns? What we look to confirm that is volume, right? Volume speaks volumes is something we say quite a bit at TRI, and because it very much does. One of the key uses of indicators in concept of divergence is to tell us about what? And that's where we're taking historical data to predict future price action. Okay, that's what we're looking for when we look for divergence. We're looking for some indicator of future price action. And like I talked about earlier, what is the ultimate fear proxy, as well as a good sentiment indicator to be aware of the market? When we talk about whether the market is in fear mode or not, what we're often talking about is the US dollar index, which is the DXY. DXY. When we see this going up quite a bit, usually that indicates there's a lot of fear in the market. So, where are we at? There we are. In building your TA tool belt as a trader, what is one of the most important concepts to understand, right? And this is the biggest one. It's about personal fit. If you don't feel comfortable with the indicator, you're not going to use it effectively. This is one of the big parts of why when people ask me, whether they should paper trade if they've already backtested, I say yes. It's about becoming comfortable with the tools you're using. And you don't get that comfort by backtesting, you get that comfort by using them. All right, what is the definition of an uptrending market, also called a bullish trend? And that is higher highs and higher lows. And conversely, the definition of a downtrending market, also called a bearish trend, is lower highs and lower lows. All right, so that was our quiz. As I mentioned, let me talk a little bit about future term structure. Okay, when you have a futures market, you have essentially two different things. We have, let me show you here, spreads. We have the spot price, which is the price of the asset in the current time frame. Okay, and then we have the price of the asset in the futures contract. So the futures contract is set up so it says, okay, what we're betting on here. Maybe better to show you here. Let me go to testnet. So these, it's important to note, these are forwards markets, not futures markets, but the idea still applies. Okay, when we are looking at price, we have a perpetual price here, so that's the closest to a spot price on that BitMEX has, right? That's the value of the asset right now, 65.45. Okay, then we have a December 28th contract. What this says is these people, the people buying and or selling this contract, believe that when we look at the current price of that futures contract, they believe the price is going to go up or going to go down. But you'll notice the price is different, right? Already the market is predicting that on December 28th, the value of Bitcoin is going to be 68.18 instead of 65.45. That is what we're talking about when we're talking about future term comparison, right? We're talking about the spread between futures prices and spot prices. Okay, and again, these are forwards in this market, and we'll talk about that fact at a later point. But essentially, futures are specific and regulated instruments. Forwards are just contracts that are betting on the forward price of the underlying asset. Okay, they are unregulated, and have a lot more systemic risk. Okay, than futures. That's why we differentiate between the two. But the idea still holds, even in a regular futures market. There is a price for that futures contract, and the spot price, and those two are very rarely the same. Usually, in a healthy building market, the futures price will be higher than the spot price, but it can also invert, where the futures price is lower than the spot, and that relationship is really important. That is one of the intermarket relationships we're talking about. So let me put it into this way and see if this makes sense. With futures term structure, we're talking about the difference between spot price and futures price for an asset. Okay. Are we going to talk about... Okay, so let me go into the rest of the questions. First of all, question 1. In this week and previous lecture, Brian points out we shouldn't take 3 indicators from the same category and consider those 3 independent reasons to consider a trade idea. For example, RSI, MACD, and OBV. Is it advisable to look at all 3 indicators to make sure they agree with each other and then call that one of our 3 indicators? I think even one of our 3 reasons, and then move on to the other categories for other 2 reasons. That's certainly what I do. So when I look at, so let me show you what my chart looks like when it's working. Okay, so when I am trading, my screen's going to be a little more complicated than what you just saw. So bear that in mind when it loads, which sometimes takes a little while. Okay. What I am looking for is, so let me hide this. So I've got the Williams percentage R, which we'll learn about in class. I've got OBV and volume, which we will learn about how those work together in class. And I've got MACD and RSI down here. Okay, we will learn about MACD. We don't so much go into RSI, but the idea is similar. So all of these are in the indicator basket. Okay, and as I've alluded to before, I have a method for adding risk into my trades. Okay, where dang it, won't let me clear those out here. Well, I can clear these out for now. It doesn't really matter. Where I can start. Come on. There we go. So I start with 0% risk. In other words, I'm not getting in the trade into this asset. When I look at location, if location is really good, I'll add 1%. But if it's just sufficient, I'll move on to the next category. Okay, and this is an important thing. So I look at these, and I recommend you look at these in a particular order. Location first. It must be in location before you move on to the next thing. Then momentum or indicators, right? And so this is how I measure my indicators. If only one indicator gives signal, I don't add a percent, but am okay moving on to the next. If 3 or more indicators give signal, I add 1% to my trade. All right, and finally price structure. If price structure is very good, I will add 1%. Otherwise, I don't add a percent, but will enter the trade. Okay, so what I'm saying here is I start with 0%. And this is just the way I do it. This is not necessarily the official TRI method, but this is how I do it. I start with 0%. If the location's really good, I'll add a percentage, so that I'm at 1% risk that I'm willing to take on that. If my momentum indicators, if I have like 3, if I have like 3 of these giving me the same divergent signal, for instance, I will add a percentage to my risk. So say location was really good and I've got 3 of these, and then I'm at 2% for my trade. And then if price structure is really good, I will add another percent to it. And by really good, I mean like if I've got a double W that came in, that's really good. There are some indicators that are some price structures that we're going to get into when we talk about candlesticks that are much shorter and don't have multiple levels of resistance. If it's one of those, then I typically won't add a percentage to my trade. But that's how I factor that in. So most of my trades are 2 to 3%. The 4th and 5th percent come in other factors. So if my fundamental screener is really strong, I will add a percent for that. And then I leave 1% available if there is some other thing, some other reason, perhaps a fundamental event or something like that, that is a really powerful indication. Okay, that's the only time I really get to 5%. So, to the very long-winded version of that question is that this is not a bad approach to look for these three indicators, make sure they agree, and call that one. What I typically do is when that happens, I will add a percentage to my trade. Okay. All right. If indicators isolate with the price of the asset in the graphic, what's the exact point of using them? They seem to be replica of lines. I think we discussed that quite a bit, and that was what I was trying to show earlier. Is what we look for is when they are not in alignment, when we have divergence. Okay. And explain future term structure. So let's go on to the quote off-topic questions. Are we going to learn about sector rotation? We don't learn about sector rotation in level 1. We do discuss it in level 3 when at the same time we discuss seasonality. But if you want to get a jump on that, this Investopedia has a pretty good article with links that talk about it, that talks about sector rotation. Okay, so I put that link in there for you. Are we going to study the long short position tool from TV? What we're talking about there is, let me close that and close this. We're talking about is this tool here. If we were to get into a long trade, right, and say we got in here, we do talk about how to use this to give us an idea of our risk versus reward. We absolutely will talk about that in more length. Okay. All right. Do we have market view tutorials on how to navigate the controls? I don't know if you mean trading view here. I am not familiar with market view. Yeah, I think you're talking about trading view here. Let's come here. I think you're talking about trading view, not market view, correct? I will do. Okay, thank you. Sorry, not trying to be a stickler. Just if you were talking about something else, I wanted to make sure I addressed it. So we don't have specific tutorials on using TradingView, but I will be showing you in the course of our videos step by step how I use them. Okay. So we don't have a separate tutorial for them. We probably should build that at some point. Honestly, we just haven't had a lot of impetus because there are a lot of videos if you go to YouTube, right? You just go to YouTube using TradingView. There's quite a lot out there on how to use TradingView. So it hasn't been a big impetus for us, but we may build that at some point. But please understand, as I teach you how to use these things, I'm going to show you exactly step by step what I did on there. Okay. So I will show you exactly how to do what we're doing for the class. Can you walk us through a paper trade example? Yeah, that's a great idea. So let me pull up the. Where do I have that? Do I have it in here? Let's see, Q2 log. So, and this is pinned in the chat as well. In fact, let me get there from the chat just so you see how we get there. Okay. So if you are, come here. If you are in the chat and you go to the upper right, you go to pinned messages, right? One of the things that I have included in here is our sample trading log. All right. I would like you to use this as much as you can. I see some people already have. That's fantastic. Except you need to make your own copy. This is my copy. Q4. All right. So in here, come in here, make a copy. That'll be your local copy of this. Okay. What I want you guys to do is, as you plug in your balances in here, or your trades in here, I want you to do that so that we can review them as we move forward. So if you are doing a paper trade, okay, let's say you, oh, why my volume's not showing up here, maybe because it's go to a daily. So what I'm doing here is re-adding the volume. So if you come into your indicator, if you don't see the volume bars across the bottom, you can go to indicators, type in volume, and just click on that, and that's going to add the volume bars to the bottom. Now some charts aren't going to show you volume. Maybe it's because the market's closed, but let me see here. There we go. All right. So let's say we were going to do a trade here, okay? What you'd do is you would say, right now you don't have a lot of tools, okay? You do have some indicators, not indicators, but some signals in terms of the market structure, right? So let's find us something that has a little bit of market structure we can work with, okay? And feel free to look at some of this historically too, though most of the time, for paper trading, you're going to want to do something more live, okay? So let me come here. Okay, so here's an example. So I see this W, and I say, I want to put a trade on this. This is where we talk about this tool, okay? So on the left-hand side, you have your different types of tools, right? One is the long position tool, because we're looking for a trade that is long, which means we're expecting price to go up. We click on here. There are 3 points to this, right? The middle point where you enter the trade, the take profit at the top, and the stop loss. When you are entering off of market structure, a W, you have to risk to the bottom of that W. And we always want to have at least a 2-to-1 risk to reward. And what we mean here is this. So see how I'm moving this and that middle number is changing? This risk reward ratio is 2-to-1, which means we are expecting price to move up twice as high as we are risking that it's going to move lower. Okay? So once we have that, what we can do is if you double click on that, it'll give you the exact values. All right? Then we can just come over, so we can copy this. I'm just hitting Control C. This is my profit level. Actually, let me start with this. We're going to start with where we get in at. I highlight the whole thing, I hit Control C. Then I come over here. What was this asset? This was LEG. Okay. And for right now, I don't care whether we're in Bitcoin or whether we're in US dollar equivalent. Okay. And we're going to, so this is, our asset is LEG. We are going to, all I want you to put in here is what's the open price. Okay. The close price is when we close the trade itself. So we're going to put the stop loss and the take profit. That's all I want. I just want the open price, stop loss, take profit, and then your reasons for entering the trade. Okay, just type those in here. So what I would do is this. We're going to stop loss here. Control C to copy. Put that in there. Come back to it. Select it all. Control C to copy. I'm hitting Control V to paste, just to be clear, okay? This will automatically calculate your risk to reward ratio as well, so you get to see that confirmed, okay? Don't worry about entering anything else in here for right now. We're going to call this no setup, all right? This lets you select from these drop downs. And then we're going to say in here, so if we come back over to here, hit OK, we can go up to this picture icon and we can take a snapshot of our setup, okay? And we come back in here and we just paste that in there, okay? That's going to show us, so we can click on that later and go, okay, here was the setup we built off of, okay? That's it. Let's just do that for right now and then put them into this central journal. Please don't rename it. Make a copy for yourself if you need a copy for yourself. I don't mind you using it, just don't use the one that we're sharing for everybody, because this is for everybody, right? You may actually want to put, let me change this up just a little bit. I'm going to remove that. I'm going to put that over here, right? That was my entry. And in here, I'm going to put this. This is my example. You don't have to put your name in here, but if you want to, that's great. Just so we can make sure we address you directly. Don't feel like you have to, but if you put some note in here, you know, like I put this as an example, you might say just testing this out or whatever, you know. But let's start logging this right away, okay? Don't worry about these fields. I'm going to gray them out, okay? Don't worry about these fields. Don't worry about these fields. Don't worry about this right now. And don't worry about this. And anything colored, you don't enter anything yourself, okay? Just enter what's the asset, where am I opening it, where's my stop loss, where's my take profit. What setup did I use? For you guys, it's going to be no setup for all of them because we haven't gone into any of the indicators yet. And give me some notes and give me a screenshot, which again, you come up to your chart, take a screenshot with that, okay? I do want you to use this tool. I want you to get accustomed to doing that, okay? And so to reiterate how we did that, we came up here. There's a long and a short version, okay? The long has the green on top. The short has the green on the bottom, okay? We want the green on the top if you're looking for the price to go up. And for now, just look for like a W or something that looks like it's going up, and let's do it as though it's going up. Set your risk to a break of new lows, and set your take profit to 2 to 1, okay? Because bear in mind, as we go through the course, we never want to see a setup. We don't want to take any setup that gives us less than a 2 to 1 risk to reward ratio. I see the trading log, but the chart is from TradingView. Yeah, that's correct. So this is TradingView here. So we went to an asset. For now, when you first go in, it's probably going to be on candles. For now, if you come up here to TradingView and you click on this little icon, you can change it to a line chart, and I do recommend you do that. Yeah, the chart's from TradingView. That's correct, Philippe. So change it to a line chart so you can see the W's and M's pretty well. And let's just do that, all right? So we're gonna find some assets that have a W. We're gonna use this long tool, long position tool. We're gonna click on the asset where we wanna do it. Make sure we're at a 2 to 1 risk reward. Make sure the risk goes down to the bottom of that W, okay? Then you take a picture of that using this camera looking icon up here. Copy that and then plug it into here, okay? I'd like each of you guys to do that in the trade in this next week, okay? The quicker you get used to doing this, the better you're gonna be about trading in general, right? This is the thing where people get stuck so often. So please go in and try this out. Come back to my video, review it as you need to. Yeah, I want everybody to collectively use the log. That's correct. Yep, you've got it. Now, if you want to make a local copy of this, please feel free, all right? But I would like to collectively use this during the course of our class so that we can get accustomed to using this, right? By the end of this course, I would like you to have entered at least 10 or 15 trades into here, okay? If not 20. So everybody take some time this next week, see if you can find a W. Just work off a line chart for right now. Get used to using this tool and looking for 2-to-1 risk reward ratios and of taking those pictures, because I tell you, we're going to do a lot of this by the time we're done trading. Every entry I put in my trading log has a picture of the chart that I used. All right, and you might get used to using this text tool too. Right now you don't have a lot going on, but as we get into this, I really like to put my location reason, my momentum reason, and my my price structure reason directly into the chart itself, because frankly I have a terrible memory, right? And when I come back to my chart and I'm looking through it, I like to see, why did I get into it? That's what we're looking for. Yeah, as Brian says, practice, practice, practice. The more of this you do, the more paper trading you do, the more comfortable you're going to be with it. I don't know that there's a time limit. I have drawings on charts that I made 3 years ago. So I don't think there's a limit currently. So yeah, I don't think there's a hard limit, Curdy. So yeah, please during this next week do this. All right, let me take a look at the doc, see if we have anything new. So that was my paper trade example, okay? And so what you do then is see. So we have this. I went back in time to do this, so let's take this off, okay? And we can see what's happened with the trade. Now, so far, from when we got in, we haven't reached our take profit, and we haven't reached our stop loss. So this trade is still going, and you can drag this out further if you want, okay? Right now, we're down a bit. We're taking some heat, but we'll see what resolves of this, okay? There's not really a hard list of assets in here. If you go to the screener, so on the bottom of TradingView on the left-hand side, there's a tab that says Stock Screener. If you want to go there, it's going to have a list of assets. You can just start looking through those if you like. So you can use, remember we did do the, where's that, FinViz. We did talk about fundamental screeners, so you can also make use of those, okay? Go in, let's make use of the CanSlim screener and start looking through these assets, okay? So you can just take these names and plug them. So AMBO, you can just come over here and type AMBO, okay? And you're gonna see that in there. So that's what I would do. Let's do that for right now. If you're interested in cryptocurrencies, look at your platform. If you're using Bittrex, look on Bittrex. All of the Bittrex assets are also listed on TradingView. So look on Bittrex if that's what you're using. You can pick one of those. I don't care if we're talking about a crypto asset or if we're talking about a stock or an index or anything like that. I just want you to get used to looking at charts, manipulating them a little bit, and with paper trading. Okay, so you might look at BTC USD and look at Bitstamp, for instance, right? And you can bring that up. Okay, I really, for me, it doesn't matter which asset you're looking at. I just want you to start looking. If you're doing stocks, use the screeners that we've already talked about. Use CanSlim, use WDB, use GARP, okay? Heck, use VCIM. If you get comfortable with that, we have a whole group dedicated to VCIM stocks. So let's start putting this into practice, guys, okay? So if you're going to do stocks, let's use the screeners in FinViz, and then bring them over to TradingView, bring up the asset, and then look for stuff in there, okay? If you're going to be doing crypto, then use whatever screening tool you're using, or just go into, like, I have all the Bittrex stocks themselves. So let me show you something here really quick. This will be helpful. If you, and I'll share this link out here in just a moment, one of our site members who is awesome is Benjamin. Where did I stick that, Benjamin? And he maintains a list of the assets. He actually has a script that runs that pulls all the assets from the different platforms into a watch list for TradingView. So let me show you how you do this. So let's say you want to look at Binance BTC pairs. Okay, so in Binance, assets can be against BTC, against BNB, or against Ethereum. Okay, so let's say we want to go here. We would go to this link. Let me share this. Okay, and then we can go to the BTC pairs. We click on that link there. That'll take us to this screen. Then we want to look at raw. Raw gives us the actual file itself. Then we just save this. So I'm going to right click, save as, and I'm going to save this on my desktop, okay? Then I go to TradingView, and so your TradingView probably looks like this. And the upper right is this icon here. This is for watch lists. I have a lot of watch lists. You probably don't have any, which is fine. I'm going to go import watch list, go to my desktop. That's the file that I just saved. I can open that, and that will give me a list of all the assets that trade on Bittrex, okay? And then you can just go through these one at a time, all right? The key part here, as Brian is saying, is find those W's. Get used to that. I actually recommend you start with weeklies. So move your time scale to weekly and just go through this watch list and look for weekly W's, okay? Weekly W right there, all right? Let me see. I think it's just you. I see myself about 10 seconds ago, which is the normal delay. So, all right. So that's the process, and feel free to come back and look at it again for grabbing all of the cryptocurrencies that are on a particular exchange. So here you have two ways of doing it. If you want to do crypto, do that. Use the watch lists and look at assets that way. If you want to do stocks, please use one of the screeners that we talked about in the fundamentals class. Okay, use Cancelim. Cancelim's going to be great. Okay, and then start looking through these assets for W's. Let's look for weekly W's. Okay, weekly M's and W's, very powerful signals. Okay, and then let's paper trade it. Let's see. We can set our risk and reward, and then put everything into here. Ignore the fields that are colored. Just put in the asset. So if this were this one, all right, I literally just come up here, I copy this, it's Control C, I come into here, double click on the cell, Control V, all right, and then I put the price in. The price is going to look way different in crypto, but that's fine, right? Current price is 0001620. 0.3? Yeah, 1620. So I'd go 0.0001620, right? And then I would establish my target and my risk. Okay. Again, for all you guys, it's gonna be no setup, but please go through the process. Select no setup, do all that. Okay. So let's do that this week. Everybody find at least one trade to put on paper. Okay. and put it on the communal paper trading log, and let's review them next week. Okay? All right. Let's see if there's any other questions we got here. Based on the trading plan, can you build a semi-automated trading system? Why or why not? Absolutely. Absolutely. Ultimately, what we want is we want to build a trading plan that executes without emotional interaction. Okay, that's really hard. We're emotional beings, right? So we absolutely can automate a lot of these setups. Um, a few, I think it's last week, maybe the week before, we had Bugra on. He was talking about his Megalodon indicator. He built that with the idea of automating what we teach in level 1. Okay. Oh, there we go. Brian's giving us an example here. Perfectly fine example on BTC at the moment. Wouldn't have a problem if you showed me this in an example of the W that I'm paper trading. Okay. Yeah. So Brian gave us this great example here. Let me bring it up. Okay. Nice W. All right. So I know his screen's a little messier than what you guys are going to see, but the key part is when somebody, and this is really important as well. You're going to see people post their charts a lot on the site. I can't recommend strongly enough. You go out and you do your own analysis on that. Absolutely, let's ride on the coattails of each other. I do it as well, right? Somebody will post something and I'll be like, that's a great idea. But the next thing I do is I then take that asset, right? This is Bitfinex BTC USD. I come in here and I put it into my own chart, right? Bitfinex, where are you? Okay. And I do my own analysis on it. All right. Does that make sense? You want to, as much as possible, replicate what they have in your own hand. That way you're really comfortable with it. You're using your setups, your tools, and that lets you really understand whether that trades for you. Okay? So let's do that. This is where it's all about, okay? Just spend some time. I know at first it's going to take a little while to do these paper trades because you're not comfortable with TradingView yet. You've got to get comfortable with it, and the only way to do it is to do it. I recommend starting with Yep, Brian said it too. So start with weekly charts, guys. Okay, it's going to be the signals are going to be a lot clearer with the higher time frame charts. It's going to be easier to see them. Once you get comfortable with them, then you can move to lower time frames. But start with the larger time frames. All right, what else we got? So automated. That's what we're talking about. Automation. You can absolutely build a semi-automated trading system. We are not going to get into that in level 1. Okay. Right now, the important part is you need to understand how this works. You have to build that base understanding first. We do touch on automation briefly in level 2, and there are absolutely people that are building automation tools around the TRI concepts. Like I said, I mentioned Bugra earlier. His Megalodon indicator is an indicator of indicators. It's intended to be something that can give us an automation signal based on multiple reasons for a trade. Okay, so you can absolutely build an automation around here, but for right now, it's most important that you get comfortable with manually doing this. Okay, we don't want to. Our goal is to teach you how to trade, not how to rely on other tools necessarily. We want you to understand how these manual tools work, understand how this analysis works, so that when you evaluate somebody's automation system, you can say, is there a way for me to get location from this automation system? Is there a way for me to look at these indicators that I am comfortable with? And is there a way for me to look for price structure within this automation tool, right? That lets you evaluate those tools. All right. What else do we have? I'm looking for any other questions you guys might have. In chat, I don't see anything there. Thank you, Anonymous Llama. Thank you for tracking the answers to the questions. That's going to be huge for you guys. Any other questions, guys? We have some more time. We're a little under 30 minutes left in this session, so please, if you have other questions, please ask them. Happy to answer anything. Like I said, I can't stress strongly enough, the more you participate in this process of paper trading, by the end of the course, the more you do this, the more comfortable you're going to be with the whole thing, and the more value you're going to get out of this course. Okay? There you go. Thanks, Brian. Brian's giving us another example here. Awesome. Weekly M. You can use this as a template. Okay? That's great. Look at this. Weekly M come in here. Also, feel free to use this tool too. Let me show you what I used earlier. This will be handy. Let's bring up that asset and I'll show you. What is this? This is IBM. Okay. So let's go to IBM. All right. Where was this at? This is on a weekly. All right. And when was this? This was here. Late 2013. Weekly. All right. Good example here. So there's this tool. It's the replay tool. This can be handy for laying out your setups. Okay. If you click, so this is up here. If you click on this, it gives you a vertical red line. And what you're saying is, I want to see things as though this were the day that I'm putting this at. So I'm going to go here, right? And all of a sudden, what we're looking at is that day. All right. Now, the thing that's nice, this would be a short, right? We might say go a little bit forward. If we hit play, it will play slowly forward. We hit pause again, right? So let's say right here, we go, okay, we want to look at this. Now note, I went over here, selected the short position. So the green is on the bottom, right? With any double top, oh, come here. Oops, I made two of them. All right. With any double top, we click on this. We have to risk to the top of that M. All right. And then we want this to be at least at a 2-to-1. So I just move that there. And this gives us our example, okay? So here's another sample. I'm going to throw this on here. This is IBM. That was our price, okay? Then we go to our, here it is, our stop level. All right, come in here, double click. Okay, come back here, double click, Control C. Back here, double click, Control V. 2-to-1. This is no setup. Okay. Brian IBM historical example. All right, and we can come in here, hit OK. Let's take a picture of this. Copy. Then we come in here and we can just paste that here. All right, so we've got that. Now here's the nice part. Once we've drawn that on here, that stays drawn on here. And if you then hit exit replay mode, we can see what happened with it. All right, came down here and it closed. Look at that. Look at that beauty. So the image that Brian's using is linked on here. If you just click on this itself, that's going to take you to the image of the chart. Okay. All right. So in our example here, well, the example that I selected is not the same one I don't think that Brian selected, but this would have closed actually, it looks like the next day, right? Or the next week. This is a weekly. So the next week, this would have just closed down right here. So pretty cool stuff, right? Now, something else to put in here is time frame. What is this? This says October 6th of 2014. We can plug that in. Let's I'm gonna hide how do I say it? I'm gonna remove the coloring on these. So let's get an open time frame so we know. So this was 10/6/2014, right? When did this close? This closed 10/20/2014. All right. This gives you the duration in hours, so you know it's 336 hours, and we closed at our price of 166.60. All right. So let me remove that, and we can put that in there as well if we have one that closed. So that gives us a good example, okay? All right. Hopefully that makes sense to you guys. Oh, you're talking about the one that I got into, or the one that Brian linked, Curdy? What Brian's looking at here, we have lower highs. So it comes down, goes to here, comes down, goes to here. Lower lows at that point. Okay. So this is Brian's I'm looking at here, right? We have this M right there. There is a W down. I don't know if that's a high or high. There's something that looks like a W down here, but that's after we've gotten into the trade already. All right. There you go, Brian. There we go. Does that make more sense, guys? Yeah, he just quickly overlaid that. Location something we're going to get into when we get into harmonics. When we start talking about Fibonacci retracements, that's when we're going to get into location. So we've got a week we'll spend on that. It's coming up here soon. Not next week, but I think the week after. So JC, we will get into location, but it's probably too much for us to get into. We've only got about 15 minutes left today, so I think we don't have enough time to really touch on it very heavily. I can give you a very, very quick example, okay? So in terms of location, do it this way. All right, so just using the same chart, what we're going to get into is how to do this at length, but basically what we're talking about is when we talk about location, we see these moves up and we'll come down a certain level, and when we're in this area, this is what we call the RLZ, that is when we talk about good location. So lines and sticks. I assume what you're talking about is wicks and tails. All right, wicks are the lines above and tails are the lines below. We will get into that, but we have a whole week we spend on it. For right now, as Brian says, let's just focus on structure. We want to get comfortable finding M's and W's, okay? The M's and W's thing is critical for everything we're going to do, so it's really important you get this down. Okay, guys. Any other questions for me? I don't see anything else in here. Yeah, I could see that. And this is where the power of layering our analysis comes in, right? Can you see how on IBM, when you see this W up here, can you see how we're at the end of a really long bull run, or at least we're at, well, let's not say at the end, but we are at the top of a really long bull run. So that location is really poor, right? We don't want to buy up at the top. We want to buy at the bottoms. We want to sell at the tops, right? So when we're really high like that, we're looking for a reason to get short, reason to go down. But you're absolutely right. This is why we have three reasons. This is why we have location, we have momentum, and we have these other things. But for right now, let's just find M's and W's, okay? Don't even worry about location yet. We will talk about location later. But we just want you to get used to finding M's and W's, right? One of the key factors of an M is the right hand high needs to be lower than left hand. Also on a W, the right hand low on a W has to be higher than the left hand low, because for a W we want higher lows, and on a M we want lower highs. Okay? Anything else, guys? Anything at all? All right. Hopefully that everything made sense to folks. Please take some time also. If you didn't do it this week, if all you did was the video, please take some time to read through the document as well. I know it's fairly wordy, but there are no wasted words in here. So please take time to really dig into this. Okay, this is going to be very useful to you moving forward. All right. Okay, I think we might wrap it a little bit early today, guys. If you have any questions, please post them in chat, post them under the document. I'll be happy to answer them. please take the time, bookmark this, take the time to do some paper trades in the community log. I know we don't have a lot of tools yet, that's fine. I want you to get used to using this. Get used to taking screenshots of your trading queue. Get used to you drawing this tool on here and identifying M's and W's. Again, go into your chart, change it to a line chart. It's going to be the easiest way for you to start seeing those M's and W's. We'll get into candles later. We have a candlesticks week. But for right now, find your M's and W's, plug in some paper trades. The more you do this, the better off you're going to be by the end of this course. I guarantee it. Okay? All right. If you're wanting to find assets to look for these M's and W's on, use the screeners that we already provided in the fundamentals. And or if you want to find crypto, just look at the crypto that's available on the exchanges that you're using. Very welcome, JC. All right, guys. I will talk to you in another week. Have a great weekend. Have a great week. And bye for now.